We start with this disclaimers. Everybody knows this. I have to put this disclaimer on so we know that trading financial market and assets is quite high of the risk and may not suit everybody. But still, I encourage everyone to try it out on the demo account. So you only trade the amount or the money which you can afford to lose. And if you can't afford to lose something for your bread and butter, please don't trade on that one, or don't put your money in the trading table. After that, what we're going to do is we're going to start a journey where we create our own success. And that success requires commitments financially, time-wise, and continue on the learning path. So keep educating ourselves with the new techniques and also with the new ideas and the new ways of the trading. The market is ever changing and the education never ends. Dedication is also very, very important. If we are not dedicated to anything, then we can just simply can't make anything. Because somebody says the screen is blurry. Okay. Is everybody else having the same issue? Please, yes, everybody says the screen is blurry. Okay, give me 1 minute. I'll try to switch the screen resolution and see if it can become much better. Give me 1 minute. Okay.
Can anyone hear me?
Yeah. We can hear you. Just to try to make the screen a little bit better. It is better now? No, hang on. It's gone somewhere else. Stop sharing. And then I shall take this one here. So shows monitor 2 on my monitor. Right.
Hello, Sunset here.
Yeah, just 1 minute. I'm trying to set up the screen. Okay, so here is the screen share, desktop. And let's start from the beginning. It is better? Is it any, the screen is any better? Okay. Yes, that's, everybody says it's better. So I think that's the best we can see at the moment. A little bit, okay. Right, so let's start again where we left. Now I have to get rid of my glasses. Okay, so we were talking about the requirement to become a successful trading and start our own successful journey toward financial freedom. So number one, as I say, is commitment and time and continue education, what you can learn, the new techniques from the market and new style and new knowledge. Dedication is very important. If you can't spare time for training or education and for the trading, the money will not come itself. You have to put some efforts and you have to put aside some time before you can do anything. Clarity of the market is very, very important. What I mean by clarity, you should know when you enter a trade, why you are entering a trade. You should have very, very clear idea about the market situation at the time when you are entering in the trade. You also need to have a clear idea why you are entering a trade. For example, is the price actually touch the support and resistance? Or you can see that price is in the second cycle or the first cycle, or there was any special news or something or events which actually push the prices up or down, interest rate. So these all are the things you want to make sure you know before you enter any single trade. If you don't have a market clarity, there is no point blindly trading. Blind trading is like a gambling, and 90% of the people in gambling, they lose the money. So market clarity is very, very important. In today's and tomorrow's session, we will learn many techniques how we can have this market clarity. And if we apply those rules, and then hopefully it will help us to make our decision much, much better and more informed. Planning. The planning starts everything. If you don't plan something and you start something, then you basically go nowhere. It's a very simple thing. In the morning, you just can't hop in the bus and hope that the bus will take you to the city or somewhere where you want to go, unless you know which bus you need to take or which way you know you want to go or you want to drive. When you have a market clarity, you start planning your trade. When you start planning your trade, you need to have a certain points in your mind, what you want to see before you can actually enter in any trade. For those people who work in air services, is like an EMS. If you don't have EMS, you can't do anything. Execution. Execution can only happen when you have a successful planning and an understanding of the market. Timing is very, very crucial for the execution. If you spend too much time in getting the clarity and the planning, and you think that you have missed the time, just move on, don't put the trade on. There are 28 currency pairs in the market. They operate in about 9 time frames, so there are plenty of opportunities coming. So make sure that your clarity, planning, and execution, they are synced. So your timing is right when you enter the trade. If you miss the trade, you miss the trade. Don't worry, don't try to run behind the trade. Let the other trade come in. When you close your trade, make sure you review everything. Because when you review, you will actually know if you have made any mistake and you won't do the same mistake or repeat the same mistake next time. When you review your trade, you know that's which elements was in the trade or your thought which make it successful. That will help you in the future trades, future trading. So these are the very, very important: clarity, planning, execution, and review. To have those 4 things, you need dedication, time, education, and the commitment. What we're going to learn in next 2 days, we're going to understand the market, chart reading, risk management, trade setup, trade planning, and professional trading. These 6 elements, once you understand, then you will be ready to start your practice in the demo account. And when you got your success in the demo account for, let's say, about 80 or 90%, then you are ready to do the trading. When I say that's in demo account 90% or 80% success, it doesn't mean that you just put 2 trades and one is right or both are right and you are okay now. You need to make sure you at least double your trading balance in the demo account, or you at least play about 40 or 50 trades. And when you got a success rate of 90 or 80, 80%, then you enter into the market for the live trading. This is very, very important, because if you don't use the facility of the demo account to sharpen your skill and to eliminate all the mistakes you're going to make in the demo account, then you will make those mistakes in the live trading. It's the same thing. And a player actually do his practice in the net or in the ground before the match. If he don't, then actually he does his practice during the match. And the result, everybody knows what's happened. Okay, this is very, very important point. We are not that smart, or we are not that big that we can make our own profit. It's not about us making money. It's about following the people who are making money, and we actually just we become a part of their business, and when they make money, we make money. Example, the big banks, the big guys like Warren Buffett, George Soros, and these guys, they actually have enough power financially, enough power, and they can have enough risk where they can try to drive the market. Our goal is just to focus. That's where they are driving the market. If they are driving the market towards a certain direction, we are following them. We not try to go against the trend. And that's why it says that trend is your friend until the end. So we only follow the trends where the market is going. We don't try to make market ourselves. We don't try to counter trade the market. The reason for this one, because we are very, very small in this business, and we can't turn around the entire river, so we just flow with the river. Everybody knows that they have a financial goal. What I want is, like, we should try to set up a goal for next 5 years. With this particular trading and starting capital, where I want to be in 5 years. Now that goal need to be very, very realistic. You can have your wish list, but if you have a wish list, then you actually have to show the commitment financially and time-wise, like how you're going to use that commitment to make your wish list come true. So wish list is a wish list until you can do something with that. So make your goals for 5 years. And let's say in 5 years, if you want to make $1 million, then you can't start with $10,000 or $1,000 and just imagine that it will make 5 million in 5 years or 1 million in 5 years. It's not going to happen. So your goal should be very, very realistic. And if you have a big wish list, then make sure like you got enough money to achieve that goal. The normal trading profit and loss, or profit, I would say, that you can make in this business around, realistically or conservatively, between 15 to 30%. So if you want to make $1 million in 5 years, then you make sure like it's 30 plus 30 plus 30. So how much starting capital do you need? Once you have this, if you don't have this capital upfront, you can also do that. You can have a smaller goal, and as you can meet your goals, you achieve your result, you can keep increasing your capital, and maybe if not in 5 years, but maybe in 7 years, you will achieve your $1 million goal or whatever your goal is. Again, when you have this 5-year long-term goal, make sure you also have your monthly goal, like how much you want to make in 1 year, 3 months, 6 months, 9 months, and 12 months. The big goal is always look very hard to achieve, but when you break down your goal into the small milestone, it's easily achievable. So I normally will say that make it 4 goal posts in 1 year, review your trading, your pattern every 3 months to see like how much you are actually achieving, and are you doing any better or not. So just looking if anybody have put some questions here, which they need to be any attention, right? This is, I actually work out a little bit, some calculation based on the percentage which I think you can make on a trading. And this is very, very conservative. So if you start with the 5,000, in 5 years, you will end up with $256,275 based on that. You actually double your capital in first year and then continue move on like that. So as I said, turning 5,000 into the $10,000 in 1 year is not that hard. If you consistently achieve about 10 to 15% every month, you are on your way. And as I say, it is not impossible to achieve such a goal in a monthly basis. Here is your, again, another short-term goal. What does it mean? That's starting with 5,000 capital, every 3 months, you need to make only $1,250. And you can see that you can reach that goal quite easily. Lots of issue with the voice quality, missing this sentence. Okay, so Irfan Akram having some issues with the voice quality. Right, so generally, okay, someone says generally, okay, so Irfan, can you please get out of the meeting and come back? Hopefully it will fix the issue. I will also try to speak a little bit loudly, and that can help this one, okay. Now, our today's agenda, this is actually half slide I was working last night and I haven't finished it. So number one, we will look at the financial market basics. Then we will go to the fundamentals of the Forex market. Then we go about the technical analysis. Technical analysis will take almost 1 day, whole 1 day, because this is the bread and butter, or this is the basic core element which you need to understand to make your decisions and to have a market clarity. Fundamental news and fundamentals of the markets, they are very important. So you can see like is any events happening in the world which are changing that particular currency. Then we will have module 4, which is a money management, risk management. Then we will have module 5, which generally about like we do some live trading. It's not live trading, but some examples trading. Okay. Someone, Nasir, can you please mute your voice and your speakers, please, and the photo. Yes, thanks. So we start with the financial investment class market ingredient to the successful trading. So these slides actually, I will go here and there because they are some of the slides, they are very, very interconnected. You need to understand first and then we go to the other. So we will actually move as we need. So let's start with here. So asset class of the financial markets, stocks, indices, ETFs, derivatives, bond, sukuk, and futures. Those who don't know what sukuk is, alternative to the bonds in Islamic market. The difference between two of them, that's in the bond, the government actually pay you interest on the yearly basis or monthly basis. In sukuk, you don't earn interest, but you actually become part of the profit and loss of that particular bond's performance. Okay, let me see who someone is there. Just 1 minute. Okay, more chat. Mute. Okay, someone got their audio mute. Can you please mute your mic and your video if it's running? Someone says the text is still not clear. It could be only you because I think other people are looking, it's okay. So, and I think that's the best I can get at the moment with the text. So it's running on the smaller screen with the high resolution. Okay, so the future market, everybody knows, is mostly derived from the communities. Yes, no, it's blurry. Okay. How many people we have in the chat? Okay, I think we just leave as it is. It will come soon. It will be a little bit clear. Yes, 2 participants have their videos on. Please turn off the videos and the audios. Yes. I think it's an issue with your phone, Hashim. Everyone else is hearing perfectly. All right, so I'll start again with the stock. So stock, everybody knows that it's a kind of your shareholding in a company. When you buy a stock, you get a certificate from them. No longer you get those certificates, all now digitals. So you basically spend the money and you got a kind of an email or something and says, yes, you own that much stock now. Your ownership of that company is registered in a central exchange, and that's a legal, kind of a legal status of your stock shareholding in that particular company. Indices is a creative idea to make some more money by some of the market makers. The way it's worked, that's because, let's say, for example, you got 500 companies who are performing very well. Okay. Someone complaining about the video is blurred. I can't do much about the blurry video because that's the best resolution I can get. What you can do, you can try to go into the computer rather than iPad and see if you can get any better option. Okay, so indices is about, let's say 500 companies. If they are performing very well, you have very little money. You want to participate on all those companies' performance. So someone create this idea that says, okay, we will actually take your money and we will take the money of the different people and we will invest all those money in those 500 indexes or 500 companies. Whatever the profit we will get, we will distribute equally as per their stock holding. And they call it index. One example is ASX 200, where top 200 companies of Australia is participate in ASX 200, S&P 500, where top 500 company globally, they participate in S&P. Who actually make those indices and who make the money? They are the market maker, the big boys, and that's how they also make the money, because they actually using your money to invest on those companies, but they also take some part of their profit because the index prices move according to the performance of those companies, but there is a little bit slippage on that. Okay, Anshu's video need to switch off. Anshu, can you please turn off your video? Okay, so we come to the future is because this is one of the area where everybody need to understand that future and commodities, they actually goes hands in hands. Future start with the commodity where like corns, soya beans, oils, and those things traders used to buy in advance. And at the time of the delivery, they actually get the price which they fix when they purchase those commodities. Give you an example, that's let's say the crop of the corn oil or crop of the corn. Crop of the corn is due in about 4 months time, but some of the traders, they come to the farmers and they say that I will buy your entire crop and I will give you that price. This is the price which is whatever is today. The farmer got the surety that his entire crop will be sold, so he agreed on this price. The agent give him a small payment. When time comes, he take the delivery of the corns, pay him the amount, whatever the remainder, and then sell that corn to the market. If at that time the price of the coin increase, he make the profit. If at that time the price of the coin decrease, then he'll make loss. Normally those traders, they are very, very clever, and they are very well trained and professional. They know that's what price they need to offer when they talk to the farmer. The same practice it's bring to the stock market. That's now you don't need to buy the entire crop, but what you can do, you can actually buy a particular commodity as a stock, as a future, and then say, okay, I want to invest in the corn commodity or corn oil. So you basically just buy a future contract, and that contract when expire, you either take the delivery and pay the remainder, or you sell your contract to somebody who really need that one. Mostly what's happened is in the stock market or in the Chicago Exchange Board, where the commodities and the future are actually traded. People like me and you, they will not take delivery, but they will actually sell their contract prior to the expiry or the delivery of that particular commodity. Now, the difference you need to note here between future and option, which we will see later on, is if closer to the expiry, you don't take the delivery. Sorry, if the closer to the expiry of the future, if you don't do anything or you don't sell your contract, then you have to take the delivery. Now you can imagine that your broker try to organize a delivery of the oil ship to you. So people normally, they actually sell their contract closer to the expiry of the contract, and at that time, if the price is higher, they make the money, which normally happens. And if the price is lower, then they actually reduce their risk, they sell the contract, and with the loss, they walk off the market. I don't actually recommend at this time that you do the future trading, because it's required more experience and the understanding, and also you need to know what exactly happening to the market. How the future is important to your Forex trading. There are some futures contract for US dollar, euro, and other currencies. All you need to do, you need to check the prices of the future contract for US dollar, and you can make some kind of guess. That's where the price is going in next 2 months or 3 months of that particular currency. So future contract of the dollar and future contracts of the euro, they are very, very interlinked with the spot prices of the Forex market. And they will give you some idea, but don't make your decision only based on the future contract of the US dollar or euro dollar. So option is another class of the trading. They are basically derivatives of stock. Someone's mic is on. Can you please turn off the mic? Please mute the mic. So the options are the derivatives of the stocks, and they are a little bit cheaper. You can see, I'll give you an example how we can actually understand what the options are. For example, there is a house. It's priced about $1 million. You want to buy that house, but you don't have $1 million right now. So you approach the landlord or the house owner, and you told him that you want to buy this house. The current price is $1 million. I can actually pay a small premium, let's say 5% of this $1 million, $2,000. You please reserve this house for me. I will buy that house. Guys, can you please mute the mic? It's very, very distracting. Please mute your mic and your videos. Okay. Right. So so let's say, for example, we're going on this example of the house. So you actually put the 5% premium of the price to the owner. Owner actually reserved the house for you. You fix the price with him of today's price, and you promise him that you will buy this house in a year time. When a year comes, you have a full right to buy or not to buy this house. If you buy that house, you pay the $1 million and you take the house. If you don't buy, you will lose your 5% premium what you have paid to the house owner at that time. The house owner have the obligation to sell you when you demand that house in that 1 year period. So basically, the price of the house when you negotiate with the owner, it was $1 million, but you put premium on that, which is about $5,000. So it was $1,005,000 you paid for the house in 2015, but now you are buying the house in 2017 with the same price which you negotiate. So now in 2017, the house price goes to $1.25 million. You have paid for the house $1 million plus the premium, which is $5,000. And rest is if you are now going to make the profit if you buy and sell the house in 2017 or 16. So this is a better option to control some of the stock which you think will go high in a price in next year or so, but you don't have that much the fund upfront to buy them. So you can use this option. I'll give you an example. Apple's price right now is $110 per share. If I want to buy option of Apple's, which expire in 1 year time, the price for this option is about $15. I will pay $15 and I will keep that stock, a control of this stock with me. In next 1 year, I have a right. Anytime I can see the price is going up, either I can sell my option contract or I can buy those stock and sell into the market, or I do nothing. If I do nothing, I will lose those $15 per share which I have paid. If I buy them, then I have to pay them the amount, $110 per share, and then resell into the market. If I don't want to do these two options, then the third option I have, I can sell my contract to somebody else. And let's say that at that time, the options contract price is gone up by $2. It means that I bought for $15. Now I'm making an additional $2 and I'm selling it for $17. So I make $2 per share straight away without putting upfront $110 at all. So you can see that if you make $2 and $110, the ratio compared with that one, that's you put $15 and you make $2 on that one. So options are very, very good. They got very limited risk. The system is a little bit complex to understand because the time decay can be your friend or enemy. Closer to the expiry of your option contract, the prices or the cost or the value of this option contract is decreased and you can lose the entire amount, because if you don't buy the stock at the time of the expiry, you will lose that $15. Okay, there is no pre or post market trading for the options, and it's not a simple buy or sell kind of things. You need to actually see how much time is left and is the price right or not, what the spread between the buy and ask price. So it's a little bit complex option, but it's very, very attractive for those who don't have a lot of money up front and they want to still participate in those high value stock, for example, Google's, Apple's, and those ones. CFDs are another kind of derivatives. It's a kind of a betting. Let's say, for example, the Australia and Pakistan playing a cricket, and the price of the betting actually changed as they actually progress during the match. If the same things happen, the CFDs are a kind of an offer from the broker to you that if the price of S&P today, let's say the price of today price of S&P is $100, and if the price is increased by $110 tomorrow, then your broker will pay you $10. If the price is decreased by $10, then he will charge you $10, or you will lose $10. Now, the important point here is that you are using index prices to actually do a kind of a betting between you and your broker. Because with the CFD, you don't buy anything or you don't sell anything. You just simply say that if the price of this particular stock or index goes up, then I will make the difference of today and tomorrow. If it goes down, then I will lose the difference between today's and tomorrow's. So it's called a spread betting system. And this is how it's actually defined in United States and United Kingdom. In Australia, it's also defined as a spread betting. And it's a 24-hour trading. And I think the people who don't like those gambling, then they don't need to trade this one, basically. They can trade future if they want. It's much better option than CFDs. So now people ask, put the mouse pointer, okay. Okay, all right. Okay, now they're asking, many people actually ask me that's, what is K5 trading? So K5 is a trading company registered in USA. It's an offshore company, not in Panama. It's wholly owned by myself. And I deal with the trading in stock, Forex. And in 2017, I got a plan to start trading in futures. Okay, now it's time to come for the brokers. So how actually the market structures works. What you need to understand that's up here, this is you trading, and you actually do deal with the broker, and there are two types of the brokers. One broker who actually operate the dealing desk, and the other broker who don't operate the dealing desk. The difference between them is, let's say, if a broker operates the dealing desk, he will compensate the winning trade, your winning trades by other clients or transfer to the liquidity market. But in some cases, what he will do, that's the losing trade, your losing trade, he will not actually put into the market or the other clients, and he will simply take your money, and that's become his profit. So it's very, very important to understand, if your broker is not a true broker or a big broker, then basically all he does, that's when you open a position, he may open a position against you. The slight volatility in the market, you will lose your money, but you lose your money to your broker. You don't lose your money to another trader who actually put the trade other way around. So basically a broker who actually trade directly with you, he is kind of a casino where you got these dealing desk and these, you put your bets, and the other side is an employee of the company who try to trade against that. So you need to be very careful when you choose your broker. I'll give you an example of one of my friend in Sydney very, very recently. Last week, he told me that he lose about $7,000 with one of the broker. And I said, what's happened? He says, I don't know what's happened, but he told me that you put your money in and you will start making money. I put the money in, and now I try to withdraw, which is, I think $180 is left. And he can't withdraw because the amount of the information they're asking is just useless. And all he did, like his broker, is suggest him like to put this trade, and that trade. But how a broker can suggest someone to go into a particular currency pair or a particular CFD or whatever, then and you can actually put your trades on that one, and basically you start losing. So basically that particular broker was collecting the money from the other traders, giving them the wrong advice or whatever. The other side of is that there are some traders who there are some brokers who are very, very good brokers. They are big companies. They don't deal with the dealing desk, and they don't deal with the traders' money. The reason why, because they are quite big. They got millions of customers, so they don't have to actually put all those dodgy deals against the traders. When you put your trades or your order into their trading system, it will straight away goes to the market, the bank, hedge fund, mutual fund, other broker, and the other client. So the broker basically just rely on his own commission, and he doesn't participate in that trading. So he is just a kind of a referee. In the other one, it's basically a broker become a trader against you. So that's very, very important. I normally recommend the 3 brokers. One is IC Markets. This is what I use, and I basically have this broker with me for some time. And when you open an account with them through me, so it will give one advantage to me, that I can actually see if you are losing any money or not. If you are losing any money, I can actually straight away, I can stop you making any more decision and review your entire trading history to see like where you make those mistakes. So IC Market is the one. FXCM is the second. Is a quite big company. Is the biggest. I think is the biggest in the world for the trading. Is American company registered in New York Stock Exchange. Another one is Alpari, Wanda. So these are the big broker where you don't have to worry about like the broker will put anything against you or he will try to play with your money. Now it's time come for the trading terminology. Ticker or symbol. Long buy, short sell. So I will start with ticker or symbol. Ticker or symbol is basically a symbol for a particular stock or a particular currency pair. Stock mean like Apple is APPL and Microsoft is MSFT. So these are the symbol when you see that's on the end on those financial TV channels and also on the stock exchange. These are the symbols actually displayed, and against that you will see their pricing. So MSFT is the Microsoft, AAPL is Apple, GOOGL, I think it's a Google, and so on. Long and buy. Okay, when you buy something, you will say that I'm long on this particular one. When you sell something, you will say short. Okay, why the difference between these two terms? Okay. Someone asking like, what's are the name of the companies? Your voice is was not clear. Right. Okay. Not hearing correctly. Okay. So what I can do, I can try to have a small break here. I will bring my microphone and see if that's actually improve your experience a little bit. But I will repeat those. Is anybody using iPhone or iPad or the mobile phone to watch this video or this training session? They may have some issues with the voice quality. But the people who are using the people who are actually using the normal computer, if they can tell their experience is good or bad. And I will actually have let's say 10 minutes break. I will come back. If I end this session to make it set up properly, then please rejoin with the same link in about 10 minutes time, because I need to put my other mic and see if that's actually improve a little bit. Okay, so let's have a 10 minutes break. We will back in, what's time now? So as we will back 10 o'clock, okay? Okay, is this voice any better? Can you please type in the chat if it is better? Recording, and let me know if it's if it's actually have any issues with the video quality. Okay, so now how to make the money from the trading. These are the key things that you need to understand how you're basically making the profit. You need to identify a trend. You need to know your entry and exit point. You need to know your risk. You need to manage your trade. You need to scan the market to find the trend-based currency pairs and manage your trading account. So these are the key elements which you need to know to make the profit from the trading, and they are not very hard. We will, as we go through, you will see and you will understand them. The first three are the very important. Identify a trend, know your entry and exit point, and know your risk. And we will focus a lot on those ones. Okay. All right. Now, this is how you actually make a profit from the trading. Increase your probabilities and reduce your risk. It's a kind of a checklist where you see lots of market condition, lots of criteria, and see, okay, these criteria, if I meet, it will increase my probability. If I don't meet that one, that will increase my risk. So the more you increase your probabilities, the more you actually increase your, the probabilities to increase to make the profit from the trading. I can give you an example, which people will understand. Hang on, someone. Video. Okay, so for example, let's say if a particular price is near the support, the price reaching the support, at the same time you got your moving average reaching the support, at the same time you can see that setup pin bar is actually telling you. So now you can see that you got three different type of the scenario which actually telling you that this is the key point to buy. That's increasing your probability. Now, let's say, for example, another thing is you can see that your price is not reaching the support, but you can see the pin bar setup. It means that your risk is high here. Your probability is low. So when we go to this price setup and all those sort of things, you will understand more. Here, you need to understand that our goal to make the profit from the trading is we increase our probabilities and we reduce our risk. These are the two things are the very important to understand. And if you don't balance them, I can tell you, you will start losing the money. You have to reduce your risk. You have to increase your probabilities. How to actually increase the probabilities and reduce the risk? So these are the 5 things: fundamental analysis, technical analysis, your strategies, and risk management will actually tell you how you're going to do that. Your trading toolbox, which help you to make those decisions, are again the same thing. I'm repeating some of those terms. The reason why, because so you can understand how important is the technical analysis and understanding the chart is. If you don't understand the chart, you don't understand the price action, then and you try to trade, then it's a purely gambling. Entire technical analysis is based on the price movement. The price movement is actually happens due to the money flow, news, and in the interest rate and different fundamentals and something else like the algorithm trading or whatever. So you need to understand the price action very carefully and importantly. If you don't understand that, don't do the trading until you understand those ones. The risk management is the third important principle in the trading. It's the reason why, because if you try to put too much money in one trade and if you lose that trade, then it's mean you're losing a lot of money. So we have some very, the ruggedized the principle of the risk management. For example, we don't risk more than 2% of our trading account at any single time. What does it mean? That if you have a 5,000 account, it means that with the 5,000 account, when you open your trade, your maximum risk on that trade, which you can lose, it should be $200 only, not more than that. So it's 200 or yes, 200. If you, it's $100, I think, yeah, or $50. So it's very important you have your risk management. $100, yes. So the proper risk and reward ratio is also very important. Sometimes what's happened that you find a perfect trade setup, but when you see that's based on the past technical analysis, if you see that your risk to reward ratio is out of the proportion, then we don't enter into this trade, because we knew that there is a chance that we will lose money on that particular trade. And we will cover that one when we goes to this technical analysis, because the risk management is related to the technical analysis. Technical analysis is actually rely on the fundamentals. So they all link together. Now we come to the Forex basics. So you need to understand some basic knowledge of the Forex trading. And as we move through here, slowly we enter into the fundamental analysis and some trading, other things. So the basic knowledge, what you need to know about our trading is the trading zone, Forex market, and all those which I point here. We will go one by one on each of them. So this is your trading zone. Forex market is a 24-hour market. It starts 7 a.m., 8 a.m. Sydney market, 7 a.m. Sydney market time, or it's 7 a.m. is basically start because of the New Zealand as well, but Sydney 8 a.m. to the 4 p.m. And then it's after that's 9 a.m. Tokyo time to 5 p.m. Tokyo, and then Frankfurt start with the 4 o'clock until 12 a.m. midnight. Then London start 5 p.m. to the 1 a.m. midnight, in 1 a.m. in the morning. Then New York start 11 to 6 a.m. Now these times are Sydney times, and it is the standard time. So it means that there is no daylight saving on this one. So if a daylight saving, it's 9 a.m. to the 4 p.m. and so on. Now you can see here that the sum of those markets, they are actually overlap. For example, Sydney and Tokyo, they overlap for quite a long. It means that Sydney market may be not that important, but the Tokyo market is, because many countries around the world, they do their exports or their trading with the Tokyo, with the Japan, and the Japanesians, it's play a very important role in the Forex market. 4 o'clock, Frankfurt start is not very important market, but when the London wake up, 5 p.m. Australian time, which is now I think 6 p.m. with the daylight saving, the market is actually on fire. London market and New York market, when they overlap, this is where you can make most of the money. But unfortunately, at that time of the night, which is 10 a.m. to about 10 p.m. to 1 a.m., we're mostly sleeping. So I don't think so you can make, you will be that keen early to make the money. So the best time for trading for us in Australia is 6 p.m. until 9 p.m. That's 4 hours of the time frame. You can make most of the money because the London market got the biggest volume of the Forex trading in the world. The Sydney market and the Tokyo market, they are smaller markets. Sydney market is just like very like people are still sleeping, having coffee type thing. You can understand that in the morning, you wake up, you go to the work, you start your car, let it warm up, and then you go to the suburbs of the small suburb streets before you hit your the main road. So that's the Sydney is like your small suburb streets. The Tokyo is your main road, and then London is your freeway where you go to the full speed. So 5 p.m. until 9 p.m. our time, this is the time. And if you can afford 10 until another 2 hours, that's the best time to do the trading. This is where when you got most of the volume. Now, the Forex market is $5.3 trillion a day market. Now, if somebody remember that's the trade deficit or the budget deficit of US is about, I think, $1 or $2 trillion. We have $5.3 trillion a day if they are being traded, and 80% of this trading happening in US dollar. You can understand how easily they can wipe their debt or their deficit. The Forex, it's an open market. There is no central exchange. And the reason for that one is because the market is actually operate through the banks, EBS and Reuters. And your broker, you connect to the broker, broker connecting to each other, and those broker connecting to the big banks like, let's say the UBS Bank or Bank of America or Bank of, or some other international banks. And that's how they actually put your order through the market. The closer to the core you go, the tighter the spread. Just follow. Okay. It's a 24-hour, 5-day a week market. When I say 24-hour, 5 days, it means that the market starts Sydney time, Monday. I think it's now with the daylight saving around 8 o'clock or 9 o'clock a.m. And it's closed on Saturday, Sydney time, around 8 o'clock in the morning again, which is New York, 4 o'clock. So it's basically 24-hour, 5-day a week. On the weekend, market is closed. I'm just going to mute you guys' videos here. Mute. Okay. Now, as I mentioned before, that's the Forex market structure, how it's actually works. So these are your brokers. These are your traders, online traders, retail traders. They communicate with the liquidity provider, which are the large banks, this one and that one. And then those liquidity providers, they connect via EBS and Reuters to each other. And then the small banks like Commonwealth Bank, National Australia Bank, ANZ, they connect to the large bank. So you understand the way the Forex market actually works. For example, you want to send some money, let's say $100 through the Commonwealth Bank to someone in USA. You go to the Commonwealth Bank, you pay them the money, they charge you $25 fees, they quote you a price, and that price most likely, let's say Australian and US dollar is 70 cents, 0.70. You just pay them $25 and say like the bank, they're charging too much money, and then walk off the bank. Now these small banks, which is Commonwealth Bank, ANZ and National Australia Bank, they actually have to collect all the Forex or the currencies of the day. End of the day, they go to their liquidity provider, which are the large bank in America or in Europe, and they hand over to them. Now, they charge you 70 cents, but maybe they actually asking the large bank 0.69 or 0.667 or 68, whatever the price is, and the bank will actually give it to them. Then those large banks actually trade with another large bank through the Reuters and through the EBS. That large bank will deal with someone in... Asif, can you please mute your mic, your video, please? And your video. Okay, and those small banks, then large banks in America, then goes back to the other small bank, and that small bank, where is this particular person? You send the money, and he actually just goes into his account. So this is the normal things. Now, when you go to the online broker or your broker markets, the spread is very, very tight here. You see here between the small bank and the large bank here, the spread was about, or maybe between you and the large bank is about, he give you 70 cents and he's asking other bank for 6.9, so he's making about a cent on that money. But this market here, they actually work very, very tightly. They work in picks. So let's say maybe a fraction of this 1 cent between your broker and you, or between the other trader in that same broker. Now, the difference of the currency here is between the broker and the large banks. They are even less fraction, and between large banks, they are very, very tight. So this spread you will understand as we move through the how the currency operates. But this is the market structure. That's the large banks and the hedge fund. They actually drive the market. They are the big players, and they trade to each other through the Reuters and EBS. And the online brokers, they connect directly with the liquidity provider. They don't participate directly into this EBS and Reuters network. And we only participate through the brokers with the large bank. Exchange rate. Currencies are always traded in a pair. The first currency is always base currency and has a value of a single unit. The second currency is a quote or term currency, and quote price refer to this currency. So example is, this is your euro, this is your base currency. This is USD, this is the quote currency. So 1 euro buys 1.22156 US dollars. So when you say that you are long in euro, what you're doing, you're actually paying 1.22156 USD to buy 1 euro. When you say that you are short on euro USD, it means that you are actually, when you give 1 euro, you will get that much. So that's what they say when you say you're long on euro USD, then it means you are buying euro dollar against the USD, and you are selling USD to buy the euro dollar. And the same thing, if you are short, then it means then you are selling your euro to buy the USD. This concept you need to understand very, very clearly. So because the people who already doing the trading, they have seen that the US dollar is going strong. And some people say, oh, the US is going strong, but on the pair, on the chart, I can see it's going down. It's not actually going down. It's a euro which is going down and the US going up, because the currencies are trading in a pair. So if the price of the euro USD is moving up, it means the euro is strong. If the price is moving down, it means the USD is strong. What is a pip? Pip is a price in point. Normally what's happened, this is the example, euro USD, and you can see that 1 euro can buy 1.22156 USD. And now you can see that after this point is 1, 2, 3, 4, and 5 fraction prices. Out of this one, we leave this last one because this is a fraction of the fraction, and we don't worry about that one. This is just because of the algorithm trading and algo trading or high frequency trader. This is important for them. For us, we only deal with these 4, which is 2215. Now, 1 is just one single unit. This is any prices from here on, it's called actually a pip. So, so if you left out this one, this is the 1 pip. This is the 10th, 100, and 1,000. So when you see that your prices is moving upward and from 1.2 to 1.5 to 1.2 to 1.6, then it means the price actually has moved 1 pip. Now, what is the value of the 1 pip? We actually coming in the next section. So as you can see here, that if the price is moved from 112 to 156 to 166, it's 1 pip. Now, the pip for USD, for Japanese yen, they are a little bit different because they're, the main base currency is very, very weak and very, very small. So we always count as 100. So basically, the pip for the Japanese is only 2 digit, 1, 2, 10, 10. So this is the 1, and this is 10, and there's 100, and this here. So you will see that when you do your trading, you will understand this a little bit more. Pip value and the calculation. Each currency has its own pip value. For example, Euro USD or Euro Swiss franc, the price of the Swiss franc and USD is 1.5250. It means that for $1 US, you will buy 1.15250 Swiss franc. And if you divide this last, because if you want to calculate 1 pip, so you can see that's 1, 2, 3, 4. So this is the 1 pip divided by this price, and that's, you will actually come up with this 0.0000657. It means that the pip value is 6.55 for Swiss franc. And it means that if you make 1 pip in USD Swiss franc, every pip your prices move, you will make 6.55 US dollar, because 6.55 US dollar, because you actually always deal in a lot in a contract. So it means that one price of the pip movement will make you 6.55 Swiss franc. Same as the USD and Canadian dollar. So $1 US will buy 1.4890 Canadian dollar, and you divide it, and that's come up with the 6.71. And 6.71 means that's when in a lot you prices move $1, 1 point, you make 6.71 Canadian dollar. And this is the Euro USD, the same calculation. You don't need to worry much about this calculation, because it's every currency pair will change, and there are a little bit different between the all of those ones. So you understand the basic point is that the 1 pip is equals to the $10. If the price is move 1 pip, you make $10. The major currencies which make this $5.3 trillion currency market a day, they are USD, Euro, British Pound, Japanese Yen, Swiss franc, Australian dollar, Canadian dollar, and New Zealand dollar. Okay. Now, why these 8 currencies and not the other currencies? Because these currencies are open into the market, and they see kind of a free floating currencies. Normally, the central banks, they don't intervene in the market to actually try to prop up or try to control their own currencies. So USD, Euro, British Pound, Japanese Yen, Swiss franc, Australian dollar, Canadian dollar, and New Zealand dollar. The top one on this one is Euro, USD, Swiss franc, and British Pound. These are the ones which can make you more money than the other one, and Japanese Yen, of course. The Australian dollar, Canadian dollar, and the New Zealand dollar, they don't have that much volume in the market, but they are related to the commodity prices. If the commodity prices goes up or down, these currency pairs will have an impact on those currency pairs which have those Canadian dollar, New Zealand dollar, or Australian dollar will have some kind of impact. So that's why you see when in Australia, when the commodity prices were quite high, our Australian dollar was very, very strong against all other currency pairs. But now that the export of those commodities are falling, the Australian dollar is also falling. What does it mean? That when the Australian dollar starts falling, it means that sooner or later somebody will say, oh, now the Australian commodities are affordable. They will start buying again. Export will increase. The dollar will increase. When the dollar will increase, export will stop, and then this goes into the cycle. Important pair to trade. As we say, there's a currency always trade in a pair. And those convention like which is the base currency and which is the code currency, they are conventional. God knows how they come up, but everybody use that. So we will also use that one. Australian dollar, Swiss franc, Euro Canadian, and Euro USD, Euro pounds, Euro pound USD. These are which in the purple, they are very important currencies. And these are the ones which make you most of the monies. The currencies in a blue, it's basically you can use during the Australian time for trading time. And the currencies in the greens, they are basically, I would say, it's a kind of a commodity base. So Canadian dollar and Australian dollar, they're commodity based. One important feature, important point about the Canadian dollar, that's when the oil prices will go up, you will see that Canadian dollar will go up, because Canada is a net exporter of the oil, and the majority of its oil actually goes to the USA. So every time when you see the oil prices going up, Canadian dollar will go up. Usman, can you please turn your video off? You look very good. Yep. Okay, right. New Zealand dollar, it's got very small in the trading, but when the important role which New Zealand dollar plays, because if you look at all those currencies, the interest rate in the New Zealand at the moment is the highest than any other currency, than any other countries of those currencies, like they're higher than Australia, New Zealand, Swiss franc, Japanese yen, and everyone. So when there is a high interest rate and the economy is performing, it means that the flow of the money will go towards New Zealand. People want to invest in New Zealand, and that's why the New Zealand dollar played a very, very important role during their trading time and also with the US dollar and JPY. Now, what is the spread? The spread is the difference between bid and ask. Bid is the price where you actually buy. Sorry, bid is the price where you actually sell, and ask is where you actually buy. So if you want to buy something, you will see ask price and the bid price. So whatever the difference between that two pricing, this is called a spread. And if the, let's say for example, here we got an example, Euro USD spread. So bid is 1.1086. It means that this is the price where you can actually buy something, and ask is 1.1084, where you can actually sell something. The difference of the two pip on these two bid and ask is the spread. That spread is the profit of your broker. It means that higher the spread, the more profit your broker will make. Now remember, we said that one pip equals to the $10 as proportionally. With the other currency a little bit up and down, but on average it's $10. If a broker making 2 pips in one lot, it means that he is making $20 himself plus the commission whatever he got. So the tighter the spread between bid and ask is better for the trader. The IC markets, the spread is very, very tight. I think somehow is less than 1 pip or 0.001 pip or something like that. So that's why you will see that FXCM's, the spread is a slightly higher than IC market. And when I will show you my chart, you will see that the difference between bid and ask is very, very small. But if you see your chart, because you are using FXCM to install this platform, their spread is very, very high. I know that there is another broker in Australia whose spread was about 3 or 4 pips, and he doesn't charge any commission. But you can imagine that if he doesn't charge any commission, which is maybe $7 or $3, $3.75 per trade or per lot, but if you don't charge the commission, and if you only got 2 pip spread than other brokers, then it means he is making $20 extra from you on that particular trade. So it's very, very important to understand that the spread should be very, very tight when you deal with your broker. Now, this spread is getting tighter and tighter as you move to the core market, which is a large bank. And it actually goes more wider and wider as you move away from the large core market, which is like, for example, the small bank like Commonwealth Bank and the Forex money changer at the airport. Their spread is very, very wide because their volume is very, very low. But as you move towards the core, the volume increases and the spread is get tighter and tighter. Okay, so lot and contract size. Currency always trade in a lot. Standard lot, mini lot, micro lot. Our most of the trading will focus on the standard lot. Standard lot means one lot equals to $100,000. If you want to buy one lot, then it means that you are buying, if it says in Euro USD, you're buying one lot, it means you are buying 100 euro. Okay, how are you going to get that money? I will show you how. Mini lot is 0.1, it means 10,000. Micro lot 0.01, it means the 1,000. We don't play with the micro lot and the mini lot, but we deal with the standard lot, which is the one lot. You can break up this one standard lot to the half or 0.25 or whatever, but our standard trading with our broker is the standard lot. So let's say, for example, Euro USD one lot equal 100,000 euro. Euro USD quote price is 1.10867. 1 Euro USD lot means that if you want to buy that's one lot, you need 110,000 $867. To trade one lot of the euro, which is 100,000 euro, you need 110,000 US dollar. And when the price actually move 1 pip, you will make $10 on that one, isn't it? If the price is moved 2 pip, then you make $20 on that. Now, how are you going to get this $110,000 to play with the one currency lot of one lot, which is 100,000 euro? Leverage. Leverage, which is your broker allowed you to deal with the bigger lot size. What does it mean? That if you got leverage of 100 to 1 or 1 to 100, it means that you actually got $1 and your broker actually putting $100. So for example, this 100,000 euro, which means one lot you want to buy, is still going to cost you $110,867, but your broker will actually give you something so you can actually play that lot and you don't lose one. So it's basically 1% of the profit and loss. So you can see here that if you got your leverage 100 to 1, it means that if you want to buy 100,000 lot, what you need $1,000 only. Now, just one question again. So before you need $110,000 to buy one lot of the euro USD with the leverage from your broker. Now you need only $1,000. With this $1,000, your prices move 1 pip, you are making $10. When your prices move more, you are making another $10. So you can see now that's how is your leverage actually playing in favor of you. It's only play in favor of you if you know how to play safely. If you don't play safely, then the leverage actually can go against you. And the way we actually do it, we use the stop loss order on every single trade. So when it's actually reach our target or our loss, we are out of the market. Okay, I will come to those questions about the interest from the broker. On the leverage, broker don't charge you interest. The broker charge you interest or broker pay you interest based on your currency. So we will cover that one later on. So here is again the leverage. So without leverage, if you want to play one lot, you need $110,867. If you want to play mini lot, then you need 11,000. And if you want to play micro lot, you need 1,000. With the leverage, broker actually will give you this amount, that's yours. So $1,108, and that's the only amount you need to actually control one lot of the euro USD, which is 100,000 euro. So 100% market exposure now, and that's what actually required. This is how actually the Forex is very, very popular in the market because of this leverage. Some broker will offer you the very, very high leverage. Some offer you 500 to 1, 100 to 1, 200 to 1, and some will offer very little, like 550 to 1. In America, there is a law that the leverage is not allowed more than 50 to 1. Rest of the world is open for as much as you can get it. And but I recommend that you go with the 100 to 1 leverage maximum. You don't go any more than that because that should be sufficient for you, and that's control your risk as well. Okay, so margin call. When your account balance falls below the margin requirement, your broker will liquidate all your position to prevent your account falling into the negative. For example, you actually put $1,000 to buy one lot of the euro USD. When the price is not moving in your direction, in opposite of your direction, when you will reach that $1,000, broker will liquidate your position because he want to prevent his own money to go into the negative. So broker don't lose anything here. Now, some broker will actually allow you to fall below to your total account balance. So if you got a $5,000, he will let your trade go up to the $5,000. It means that's wiping out your entire $5,000 and then asking you for more money. And this is actually called margin call. And margin call is very, very important. That's money management and risk management. If you don't do properly, then you will get this margin call. The first principle of the trading is protect your investment. If you can't protect your investment, then actually you can't make money. So the protecting your investment is the first rule. If you are good at protecting your investment, the profit will come itself. Okay, so how do we trade Forex pairs? So this is what I have, buy and sell long and short. I think this slide is a little bit, yeah, that's okay, that's right position. So for example, let's say the currency Euro USD price at the moment at this point, 1.22560. Okay. Okay, this kind of question, like someone asking that individual lot with the different broker for not falling through this margin call, I will answer those questions at the end of this session. So Euro USD is 1.22560, let's say for example, and your expectation is price is going to up in this direction. So you actually go long at this place, 1.22560, you buy one lot of Euro USD, the prices move higher, higher, higher. Now it's coming to the sell point, you sell at 1.22570. It means the difference between your buy and your sell is a 10 pip. 1 pip equals to the $10, total profit is $100. So you can see that's when the prices actually move from this price to this price, making 10 pips, you actually make $100 profit. On the other way around, Euro USD, the price is actually, you expecting this Euro will actually drop against the USD, so you actually do a short sell here, shorting. It means that you are selling US dollar at 1.22560. When you sell this one, then it means that now the price is actually, so basically, sorry, you're selling the Euro and buying USD here. The price is going down. When it reached this level, 550, the difference, this two is again the 10 pips. So you buy back your pair and you close your position. That's actually, you're making 10 pip again, and that's $100 profit. So you can see that if the Euro goes up or the US dollar goes up, when the US dollar goes up, it means that's the Euro going down. If the Euro goes up, the price is going up. So you can actually make the, your trade in the both direction. So you can say, yes, now the Euro is strong, I will buy. Now the USD is strong, so I will sell the Euro or I will short on the Euro. Okay, so that's market order. Right, so the market orders, there are 4 types of the market orders, which we're going to focus. Here you can see the 6 market order, but we will not actually go on all of those. So one market order, which we actually, the market order which I actually try to promote and we should use it is a stop buy, stop sell, sell limit, and buy limit. I don't recommend doing buy and sell at the market order. The reason is that by the time your price is executed, if the market move up or down, then you have this slippage in the market. So for example, you are actually put your order at the market price right now, 1.25, you enter your order and it's take about maybe 3 or 4 or 5 seconds to execute. If in this 5 seconds, if the price moves against you, then you start your order as a loss. So market order, don't do it, only do it when it's necessary, but try stop buy, stop sell, buy limit, and sell limit. And how to do this one is coming into the next slides. So that's buy order. The price is currently here. and you're expecting this prices will go up. So you put your order above your current prices wherever you want to go, and you call this one buy stop. The prices is now moving up. It hit your buy stop, execute your order, and then price continue to move, and then you make your profit. The reason I propose this one is because you want a confirmation that yes, prices is moving is in your direction. So that's why we use the buy stop. If you say, okay, current price is here, I know this price will go up, but I want to buy a little bit here so I can have a little bit more profit. But you never know that the price is going to go in your direction or not. Maybe the prices start falling. Once they start falling downwards, then it means that it will hit your order here and you will start losing the money. So the buy stop means is a confirmation of the price's movement in your direction. So always use the buy stop order. I never use buy limit. I only use buy limit when there is a need, but most of my orders, they are actually buy stop order because I know that the price is moving upward, but I don't know what the next move will be. If the next move is against my buy stop order, then that's fine. I'm not actually entering into the market and I haven't lose anything. But if I put my buy order here somewhere and the prices I'm expecting to go up, and then it's falling down, then I will start losing. So it's very important that the buy stop means that you are confirming the market movement, and the buy limit means that you are waiting for prices to go down and then come back to your particular order. So this is we use mostly in the stock market, and this one we use in the Forex market. Because in the stock market, you know that during the daytime, the prices will actually go down, up and down, and somewhere it will hit your price. So say, if this is the current price, I want to buy few cents lower, so I'll put my buy limit here, and the price actually will go down, come back, and it will hit my order. So this is very, very popular in the stock market. Buy stop is very popular in the Forex market. This is the same thing true for the sell order. So sell order means the price is moving down, and you know that you want to actually sell Euro USD, and you are waiting your confirmation, and the confirmation is that if it's going down, when it hit my order here, then I will actually sell it. So that's your sell stop and the sell limit. So it's the same concept as the buy order. So you use your sell stop to confirm the pricing, and you use your sell limit to actually try to buy a little bit cheaper, but that's high risk strategy because you don't know that the price will go in your direction or not. So we always use buy stop and sell stop in the Forex. Sell limit, buy limit, you can do in your future, you can do in your stock market. You can also do a very, very limited in your Forex, but only if you know that the price will actually have moved up and now you want to enter into the market, and you know that's if it's come down a little bit, that will make. We will go these examples when we go see in the chart. This is the MT4 order screen, and Euro, New Zealand US dollar, and then you can see here that you can actually have a market execution, which is a market order, not recommended. You do a pending order, and then on the next screen, will actually tell you like you got those 4 options: buy limit, sell limit, buy stop, and sell stop. You choose one of those, put your price. If the price is not valid, it will play an error message and says that price take profit or stop loss is not valid, and you have to actually fix it. For example, if the prices is right now here, and if you want to put some prices up here as a buy limit, it won't execute your order because it's invalid order. But if you put at this price, if you put up here as your buy stop, then it will execute, and vice versa. Okay, anybody have any question now? So I can take the questions, and then we will have another about 10 minutes break, and then we will come back because it's almost 10 to 11. So one question I got here from Mustansar is, shall I play individual lot with the different broker for not falling through this margin call? No, this is not the idea. Idea of the margin call, to avoid the margin call, you use your stop loss properly, you use your money management and the risk management properly. If you go through the different brokers, then it means you split your investment, and maybe that's will actually not wise because you have your you will have a margin call from almost everyone like that. So it has to actually put your risk management in play, and if you have a proper risk management, then you won't have any issue with the margin call. Is there any interest from the broker? Broker don't charge you the interest. Broker is actually the money from the leverage. The leverage from the broker is a kind of a virtual money, and broker don't lose money because the minute he will see that your $1,000 is gone negative, he will try to close your order, or he will drain your entire account and liquidate all the positions. So he won't lose anything. So he don't care about the interest on those. Any other question? Okay, so we will be back 11 o'clock. Then we go through the carry trade and some fundamentals. Then we start with the some technical analysis. Okay, so we will be back at 11.